Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We are excited to have you. Josh Knoll here. Sorry, regular listeners. Michelle is off again, yet for another week. She's recovering from her trip to Costa Rica, and I went with her. So when you hear this episode, we will be back in town. But we welcome back one of our regular co-hosts. That's Mr. Jay Stubbs, the director of the Gulf Coast for Providence Partners, which happens to be the sponsor of this show. Jay, how you doing, buddy?
Josh, I am doing great. It's glad you're back and safe. Hopefully you guys had a great time. I'm sure you did.
Incredible time.
Delayed honeymoon, right?
It was a delayed honeymoon. That's right. So had to pull Michelle's arm to get her to come back.
Well, welcome back.
Yeah, thank you. Jay and I, we're back here again, Coastal College's recording studio, beautiful downtown Fairhope, ready to put on another great show for those of you tuning in. Listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store for you today. First segment, deep dive on our topic of the day. Second segment, about 25 minutes past the hour. That'll be news headlines of the week. And then roughly 45 minutes-ish past the hour, stick around for our third segment. We call it Joshua's Crystal Ball and Big Mouth. And of course, we'll see what Jay's crystal ball had to say about anything. So buckle up. We've got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call at 251-327-2124. Now, if you miss that contact info, just grab a pen and pad, get it ready for next time because we repeat it several times throughout the show. All right, Jay, we got one big thing before we get to our main topic.
What is it?
We have a very special guest in studio today, and we have a big announcement. God knows I love big announcements for my firm, Gulf Coast Financial Advisors. Listeners, I'd like to introduce you to Pedro Cardozo. He is joining my firm as a producer and will be running our Orange Beach office. Pedro, how are you doing, buddy?
My goodness, I'm doing fantastic. It's an honor to be here, Josh.
Well, tell us a little bit about yourself, or how excited are you to get going? Because I know I'm excited.
Well, I'm thrilled. I'm absolutely thrilled. I mean, we've met a couple of years ago, and since meeting, we've traveled together. We've gotten to know each other a little bit, and played basketball together quite a bit.
Yeah.
And I feel extremely humbled and honored to be picked to be part of this great adventure that you have going on, and I'm excited to hit the ground running.
Well, Jay, Pedro still hustles on the basketball court. I am in the phase of my career where I jack up threes and I play no D.
That's right.
Right? But I've also been through a zillion injuries at this point, so my playing hard days are long behind me. But sorry, so Pedro, congratulations. We're so excited to have you. Again, going to be running the Orange Beach office. We're going to try to do a great job of getting your name out there, getting out involved in the community. Foley, Orange Beach, Gulf Shores, anywhere down there, it's going to be fantastic, okay?
And Pedro, you've got a little bit of a interest in the risk management side of things. We were talking earlier how you had a family loss, and that was something that you were impacted your family, and I'm excited about that, as Josh knows, and everybody listening. I'm obviously with risk management expertise. I'm looking forward to assisting you as you work with clients, and not only in their management of their funds and their retirement planning, but also potentially their risk management planning.
Absolutely. I look forward to it as well. And just listening back to the episodes that you guys have had, and it's super exciting to be here with two famous guys.
There you go. That's right. Well, thank you for that cue up. Listeners, before we get moving on with the show, if you want to hear previous episodes, go to the website, gulfcoastfa.com. Go to the podcast tab. You can see our entire catalog there. All right, well, let's get on with our main topic of the day. This episode is titled The Science Behind Risk Management. Now, what does that mean in plain English? What it means is Jay and I are going to break down the science about how life insurance, disability income, and long-term care insurance work. We're going to talk about the differences between individual and group coverages. And probably, in my opinion, most importantly, we're going to talk about the steps that you listeners need to take if you're interested in these different types of coverages. How do you apply? How does underwriting work? Again, that will kind of tie back into the science of how life insurance works, because it can be a little bit of a black box. And I think it's good for not only you, the listeners, to know this stuff, but it's good for us advisors and producers to be reminded, hey, there's a reason and a science and a methodology to how we do these things. Let's talk about it, okay? So, Jay, what I'm looking for from you and I, we're going to define the insurance, the type of insurance. We're going to describe how it all works, how the sausage is made, and then we're going to lay out how people can apply for these type of coverages and what the underwriting process looks like. Does that sound good?
That sounds great to me, Josh.
Okay. Well, let's start with the big dog, if you will, life insurance. Okay. So, Jay, what I want to start with the life insurance. Let's talk about the different types of life insurance, and I'm gonna lay out what I think they are, and then I'm gonna let you expand from there. And then let's talk about just in general, what's the black box look like when somebody actually applies for life insurance. So, listeners, life insurance, we've got term insurance, which can be broadly defined by level term and yearly convertible term. We have permanent insurance, which can be broadly defined as whole life and the various types of universal life. And of course, we have group and we have individual, which we'll touch on towards the end. And so with that, Jay, let me kick it to you. When somebody says I have term insurance, what's that mean?
They are renting a death benefit for a specified period of time. They pay a premium either monthly or quarterly or semi-annually based on their sex, their male or female, their age, the fact that they, or if they do or do not use any form of tobacco product. That's a whole nother discussion. We do need to dive into that because there's lots of different types and uses of tobacco in this day and age. And then, of course, other medical components, height and weight, if they're on any kind of medications. But at the end of the day, when we need to get a quote for somebody for term life, we need to know when they were born, their date of birth. We need to know if they were male or female. And folks listening, that is what is on your birth certificate. What you were born as in the United States or in anywhere in the world, that's what we use. And we need to know how much coverage you're looking for and for how long you want to have that. And then do you use any form of tobacco product? We then plug that into calculators. And Josh, the science behind the calculators is something I want to get in the weeds just a minute. And you pull that weed whacker out and let me know when you're done. All right. So people are like, well, how does term life insurance, how is whole life insurance, how is universal life insurance priced? Where do companies come up with that? Well, there's a thing called the CSO tables. CSO stands for Commissioner's Standard Ordinary, CSO tables. And those tables are mortality rates of all people in a specific country. Then that can get drilled down to regions, states in the United States, and of course, even down to the zip code and male or female, and then how those people passed away. That is a mortality rate that is calculated, and those are off of actual deaths, and they calculate it per 1,000. So the CSO tables, life insurance companies go grab that data, and they don't grab it every year. A lot of insurance companies were using the CSO tables from 2001. Then they went to the 2017 CSO tables. Obviously, as people live longer, tables and data change. I know that this is getting in the weeds, but hear me out. CSO tables data is then used by life insurance companies and their actuaries to price the products that they offer. So I'm not going to go any further than that because everybody will turn off the radio. But I will tell you that that's how insurance companies price. Actuaries price based off of mortality rates. And that's based off your age, how old you are, whether you're male or female, and then where you live.
Okay. Well, hey, so you said the tables went from 2001 to 2017, correct?
Yes.
That's a huge...
Well, there's others in there.
Right.
2011, about every 7, 8, 9, 10 years, when there's a major change in the mortality rates,
right,
that's when an insurance company will come out and say, okay, it's time for us to reprice those products.
Well, okay, so here's the thing, Jay. We have an article where we talk about some of the changes in life insurance underwriting over the years, so I don't want to pull the legs out under that. But I do want to ask you this question. We did not prep for this. But in general, has life insurance pricing, and of course we're still in the term world, has it had a downward trend over the last handful of years?
It has, up until we hit COVID.
There you go.
So,
because when you're saying updating that table, I know for a fact that life expectancy has changed dramatically. Not quality of life. One would argue that's actually maybe degraded, but life expectancy has increased dramatically over the last couple of decades.
It has, and then we hit the COVID year, which is an anomaly year. And so, a lot of companies use those tables just to price things out. So how it has affected pricing over the last several years, or last decade, we've seen rates per thousand for term life insurance come down. That's what we call the term life insurance wars. That's all the companies trying to be as competitive as they can to offer a product that makes an insured want to purchase their product. And Josh, you and I both know there are so many good life insurance companies out there. We represent a good many of them. We look at A-rated or better when it comes to ratings. We had a previous episode where we talked about that. But at the end of the day, if you're with a competitively good rated company and you're hopefully in the top 10, you're going to get a competitively priced product. Now, how long you want that and how much, that then drives that price up or down.
Okay, so put a pin in that, Jay, because I want to talk about whenever you're able to price out the life insurance people rate the rates, and you're talking about competitive, you actually have the ability to see in so many words, the insurance carriers are fighting for that business.
They are. That's competitive. Some companies don't want the term life insurance business, so they drive their rates up.
That's true.
And they'll say, hey, you can go over here, to XYZ carrier and get the inexpensive term rates. Those are usually the ones you hear on the radio.
When Big Al and Big Lou.
Big Lou, yeah. He's just like you. He's divorced and has four kids with two different wives too. Those are the types of companies that try to be competitive. But at the end of the day, what we want is a fairly priced product with good underwriting understanding, so that we can go through in an efficient manner, get a product that's going to have a risk component that's filled. We don't want to have a family with a couple of kids not have a very affordable insurance plan.
Okay, so let's talk about that, affordability. So we're going to stay on the term thing before we pivot to the permanent. There is level term and there's yearly convertible term. I think pretty much anybody's heard of level term.
Yeah, so 10, 15, 20, 25, 30, and then over the last several years, we even now have 35 and 40-year
That's
term.
crazy.
Yeah.
That's incredible.
And all it is it's a calculation of that using the mortality rates.
Right.
The actuaries price it in and say, here's what our term premium is going to be for that specified period of time. It never changes. As long as you pay that premium, you've got a guaranteed death benefit until the end of that term period. You mentioned YRT,
yes,
yearly renewable term. Sometimes that's called ART, annual renewable term. They're one and the same. We can actually get a 1-year death benefit on ART or YRT, and each year our rate goes up as we age.
Right. Well, because when you do level term, let's finish that conversation on this part. When you do level term, in general, you're overpaying a little bit in the beginning to underpay in the end.
Yes,
right?
Because if you look at the actual term rates for a 60-year-old person for $500,000 of coverage versus a 30-year-old person for $500,000, the 30-year is obviously a lot less expensive. 60-year-old is much more expensive because their longevity and their likelihood of death is higher. What they do is they take that over a 30-year, the total premiums, they add them all up, divide by 30, and get an average.
Right.
And that's your average. Yes, your rate premium for whatever your term period.
All right, so Jay, pivoting now to the permanent side, and here's our transition. You mentioned that some companies are going to overprice their term because they're more focused on possibly the permanent side of the industry. And some companies, maybe someone is willing to possibly overpay a little bit in the beginning on a term policy because it has convertibility privileges.
Rights of conversion to these permanent, I like to call these permanent ones longer lasting policies. You can dial in a guarantee, Josh. We've had clients of yours that have said, hey, I need something that's going to get out to my life expectancy. Well, the life expectancy for a 50-year-old man is probably 85 to 87 years old.
Right.
So if we get something out to 85 or 90, he or she might be fairly comfortable with that. Some are using it for estate planning, and they need something that's going to go out to at least age 100. From a fiduciary responsibility, trust-owned policies, they got to go out to at least 105. But you can actually dial in a death benefit guarantee all the way out to age 121, with some companies even 125. But the conversion is saying, I've got a term. That conversion privilege allows me to convert without proof of insurability, so I don't have to go back through underwriting to get that more permanent or longer lasting policy, which is typically going to be whole life or universal life. And there's different variations of those two types of products.
Well, and when they do that conversion, wrapping up this piece of it, you just mentioned they locked in their original insurability, but the premium's going to be based on what's called attained age.
Attained age rate,
right.
Yeah. So whatever they got when they bought the term, they were assigned a risk class. Preferred best, standard. They were also assigned a smoker status, tobacco versus non-tobacco. And some companies allow good, healthy, even though they use a tobacco product, they'll allow for a preferred tobacco rate. Some companies say, hey, if you're going to use a cigar occasionally or dip or use some form of tobacco, chewing tobacco or even nicotine in your system with Zen pouches or what have you, they'll still give, as long as you disclose it, they will give those insureds non-smoker, non-tobacco rates.
I like it. All right, let's pivot now. So listeners, at the end of this segment, we're also going to talk about what it looks like to apply in the underwriting process. We're going to do that for all these three different classes of our primary insurance products that we talk about. We just talked about life insurance. Jay, let's pivot to disability income. All right. So disability income, we've got two kind of broad classes to put them on the shelf. We got short-term disability versus long-term, and then we have group versus individual.
Right.
Now, of course, the group versus individual is an important factor on life insurance. It's even, in my opinion, an even more significant factor when it comes to disability income. So let's talk about a little bit first, short-term versus long-term. I'll set up the short-term, you take the long-term.
Absolutely.
In general, short-term disability income is typically not sold on the individual level. Your biggest player or one of your bigger players is going to be thinking Aflac. Short-term versus long-term. Jay, I'm going to take over the short-term discussion on this. So short-term in general is going to be only available on a group plan level. Think about one of your bigger players is going to be Aflac, and you're going to have a benefit period. Usually that's 3 months, 6 months, 12 months, or in my opinion, the longest short-term disability policy that you're going to find is 24 months. When I kick it over to Jay, that's going to make more sense on how that relates to long-term disability. So short-term disability, generally speaking, is intended to cover things. You get in a car wreck, you break a leg, you've got COVID, you're sick for a time period, you're out of work for a couple weeks up to a handful of months. It's meant to cover that short time period of some type of thing that, generally speaking, you're going to get over. Because if you can't get over it, if you've got a disabling event, whether it's an accident or a serious illness, now we're starting to make the transition to long-term care insurance, which I'm going to hand it to you, Jay. Tell us the listeners a little bit about what is long-term care insurance and how are those rates
Well, you mean long-term disability?
Thank you. Long-term disability.
Yeah, you got so excited on short-term. Look, short-term, a lot of people listening, if you work for an employer, you're probably offered a short-term product, and they are extremely important. It's not designed to be hurt on the job. That's workers' compensation. It's designed to give you a benefit if you can't get over there and do your job on an hourly basis or a daily basis after a major illness or a certain situation or a car accident, you've broken something. So short-term is extremely important, but usually it's limited. Long-term disability is typically going to be at the shortest long-term disability plan I've ever seen is 2 years.
Right.
So once short-term kind of caps out at 24 months, again, some are 13 weeks, some are 26 weeks, some are 52 weeks, some are 2 years. It just depends on what you're provided through your benefit package. Once you hit that, I think I want it for a little bit longer. What if I have cancer and battle this thing for a long time?
Right.
What if I actually have the loss of sight or a limb, or if I'm a surgeon, or if I'm an engineer? It doesn't matter what type of occupation. If you have the loss of something and you cannot perform your job function, that's deemed to be disabled, not able to work in your job. 2 years, 5 years. Usually, we want to see somebody get out to retirement age, 65 or 67. We can even get long-term disability out to age 70. And, it's based off your age, your occupation, your male, female, and certainly that occupational class that you are in. What do you do each and every day to make a living? How much money does the insurance company need to replace? The magic percentage we use is always 60%. So if I'm a skilled worker and I make $200,000 a year, then I want to try and replace at least $120,000 of that, because disability, long-term disability, if I own it outright, is not taxed. I'm going to replace my income. I'm going to be able to pay those bills at home.
And so a couple things, Jay. One, listeners, you can have short-term and long-term.
You certainly can.
Right, and you see that a lot. Again, now you don't see a lot of short-term in the individual space. In fact, as far as I know, Jay, the only major player there is Mutual of Omaha.
Yeah,
maybe.
Maybe, and that's even like a critical illness.
I
type
agree with
plan.
you, right? And then, so you can have short-term and long-term. And then wrapping up that part of the discussion, Jay, you mentioned occupation several times. On long-term disability, which generally speaking tends to be a little bit more robust product in the short term, it tends to cover a little bit broader range of things. And to be fair, in general, it tends to be maybe possibly a little bit more expensive depending on your elimination period and the benefit. But talk to the listeners as we wrap up that as part of the science of how this is done. What about long-term disability and own occupation?
Yeah, so most disability products come in there and say if you can't go to work, so if you're stuck at home, you can't. You're going to be on disability claim. You'll be able to file for your benefit. Some more skilled workers, think physicians, attorneys, engineers, they actually had to go to extra school to get that job and do what they do on a daily basis. Surgeons, dentists, orthodontists, you name it. They could become disabled and not do their job, their own occupation. They could actually go do something else and make a living, maybe in real estate, maybe in the investment advisor community. Or teaching. Right. Yeah. So as long as you want to make sure that your definition of your occupation is very detailed in your own skilled occupation, that your disability policy spells that out in black and white.
Right.
So that if you're a surgeon and you can't perform the duties of a surgeon, maybe you've had a hand issue or a back or a neck issue or an eyesight issue, then you can go on claim, but it doesn't mean you can't go make a living doing something else. And that is a very important characteristic of a lot of insurance companies that offer disability solutions for their clients. Is some offer occupation limited for 2 years, your own occupation limited for 2 years. Others offer it for the lifetime of the contract. So you always want to do a good review of your disability policy to see if it has own occupation or not. Now, you may just be a very good real estate agent, and you go get a traditional disability plan, and that's going to work because most people that aren't in that world, if you're just being able to talk to people, being able to get around and mobile and drive, if you can't do those things, you're on disability.
Right. Very good. All right. Last piece, long-term care, right? So, Jay, let's talk about quickly. Now, this is a hot button. This is one, I mean, is it fair, like when people listen to the radio show, this is the one we get asked about the most?
Yes.
Right.
Only because everybody's experiencing it, whether they have a loved one. So it's somebody's experiencing a loved one or has experienced care for that individual at home or in a facility. They've visited grandmother. They've visited Uncle Bob. They've seen Aunt Sue go and decline health-wise. And sometimes there's a long-term care plan in place, and sometimes they're not. But the likelihood of experience is much greater in this day and age as longevity creeps in. Mm-hmm. Gone are the days that I like to say of having the heart attack on the 18th green after you've made the birdie putt. Right. They're going to resuscitate you on the 18th green and get you back out of the hospital quickly, get you back on your feet, and hopefully you live a long, prosperous life into your retirement years. But what if that ailment or that issue creates a situation where you can't do 2 of 6 activities of daily living? That's where we come in with long-term care. You need a little help at home, whether it's skilled or unskilled nursing care. And those are some expenses that a lot of people don't plan for, but they see other loved ones or they hear news stories about, oh gosh, this is something we need to plan for. We don't want it to affect our retirement. We don't want it to affect how much money we transfer to our kids or our grandkids. So long-term care planning is extremely important in this day and age.
All right. So just as we talked earlier about some of the things that have changed with life insurance over the years, Jay, long-term care has been a division of the insurance and risk management industry that has changed dramatically. Long gone are the days of you paying a premium and getting a benefit if you need it. If you don't need it, similar to car insurance, well, hey, at least you had the coverage even though you kind of wasted your premium dollars. I want to kick it to you as we start winding down this segment. What are the different ways? What I just described was conventional long-term care. And of course, people can do what most people refer to as self-insure, which you have a different take on that.
Yes.
And then, of course, there's the spin down to Medicaid. But if you don't mind, walk through, folks, the differences and all the different ways they can access handling long-term care and extended health care events.
There are 4 ways that somebody could fund long-term care expenses. Number 1, you said self-insure. I call it self-pay. When you self-pay, that's not insurance. That's not using pennies on the dollar to get leverage for the amount of benefit that you receive. So there's self-pay. A lot of people out in the marketplace, maybe even listening to this, say, I got plenty of money in the bank. I could self-pay. Well, let's model that out. What if you have an episode that creates a situation where you need care for 2, 4, 6, or even 10 years? What's that asset or that account that you were going to use look like now? Are you having to liquidate something else in order to help pay those expenses? So you can always self-pay. In fact, everybody without a traditional or a hybrid type policy is on self-pay.
Right.
You and I are on self-pay if we don't have a policy.
Agreed.
Second one, traditional long-term care, just like a homeowner's policy or an auto policy, you are buying a benefit for a specified amount. Most of those cap out at 6 years of benefit period. And it is the least expensive way to get a long-term care plan for your own use, or you and your wife or your husband. But it's limited in duration. Can't really go anywhere more than 6 years. Once that benefit is exhausted, it's gone. And we pay a premium that if we never use that benefit, that premium is not anything we can get back. So a lot of people look at it like auto insurance policy. You got to have it, but if I don't have a car accident, I never get a benefit. If my house never catches on fire, I'm never going to get a claim from that either. So traditional, while it's very important for people to understand that it's the least expensive, it also comes with a little bit of caveats. You can get an insurance rate increase based on the claims experience of that traditional LTC company. So you might be a policyholder and in year 7, 8, 9, or 10, get a letter that says, hey, Josh, thanks for being a policyholder, but based on our claims experience, we now need to charge you a little bit more for your benefit. You can either accept that and pay a little bit more, or you can say, no, I don't want my premium to go up. I just want to reduce my monthly benefit. So traditional is the second way, self-pay, then traditional. Then we have life insurance with a rider. A lot of folks still have a need for a life insurance policy, whether it's $1 million or $500,000 or $200,000. Maybe there's a mortgage. Maybe there's still kids under the roof. Maybe there's grandkids because we have a unique family situation. Maybe there's business debt, lines of credit. We still need a need for a life insurance death benefit that's pretty robust, but we also understand I can get 2 birds with 1 stone by adding a long-term care or a chronic illness rider to that. Now, if you have an existing life policy, you can't go through and add a new rider. You have to actually go back through underwriting and get a new product that has that rider availability to it. So it becomes a product that gives you 2 things. Pedro's listening. We get a death benefit. Mm-hmm. If we die, that gets $500,000 to our beneficiaries, income tax free. If I need long-term care, if I can't do 2 of 6 activities of daily living, I now have a $500,000, $500,000 pool of money that I can accelerate and help me to pay those long-term care expenses for at-home care or in a facility care. That's called life with a rider. So that's the third way. Then there's a hybrid approach of all of that. And these are the ones that we like to look at really for the folks that are 55 and older. There's great companies out there with great products. We won't go into specifics today, but they give you leverage on the money you put in. So if I'm going to, maybe I can single premium pay it or 5-year pay it or 10-year pay it, I can design a plan that's going to be there that gives me a monthly benefit to help offset my expenses. But if I never use it, it comes with a small amount of residual death benefit that goes to my beneficiaries. So there is a return of premium function to it. And there's also companies that allow for you to put a husband and wife on one contract. They are specified duration contracts, or we can go lifetime. So there's all kinds of ways we can design them. Typically, the husband and wife, or the widower, or the widowee, or the divorcee, we're looking at those hybrid type contracts at 55 and above. If they need significant more life insurance, we'd look at life with a rider. If they are just watching dollars and cents and want to have something that's very affordable, we look at traditional.
All right, very good. So listeners, we just talked about life insurance, disability income, and long-term care. Pedro, you had some thoughts.
Well, I just wanted to ask Jay, because in a previous episode that I listened to you guys talking about long-term care, and I think listeners would benefit. The statistic that you pointed out for how many times a person will experience long-term care after 65.
Yeah, so once we hit the age of 65, the likelihood is it's like over 70% will experience some sort of need for long-term care. Can't not do 2 of 6 activities of daily living. And just to rehash those, Josh and Pedro, we think about getting up out of the bed. We think about that's getting up and moving around. Then we think about we go to the restroom, we brush our teeth, we bathe, so bathing. And we also think about dressing, and that's important, being able to dress yourself. Then we think about walking down the stairs, so transferring, getting from point A to point B. Then we think about feeding ourselves. And then, of course, we have to go, after we have breakfast and our coffee in the morning, we have to go to the restroom. So we think about continence and the ability to toilet. So those are your 6. And then, of course, we have cognitive that we can put in there as well. So very important. If you can't do 2 of 6 or you have cognitive impairment, you can file a claim on long-term care.
Very good. All right.
But Pedro's right. The likelihood is higher as we get older.
100%. All right. So, listeners, you've heard about the particulars of the life insurance, disability income, and long-term care. Now, as we wrap up this segment, I want to make a couple things crystal clear. So first, if you are interested in continuing this conversation, obviously Jay Stubbs, for any of y'all that have visited the website, gulfcoastfa.com, if you go under the team tab, you will see Jay there as the risk management consultant for Gulf Coast Financial Advisors. Now, what does that mean? Jay technically or officially serves as the director of the Gulf Coast for Providence Partners and Providence Benefits. If you're interested in having a conversation about your risk management, which generally speaking, if you're calling us as financial advisors, you're probably wanting to have a broader conversation about financial planning. What that means is you can incorporate Jay and all these conversations into your financial planning conversation. We can reach out to him and we can start not only the conversation process, but we can, Jay, I'm going to kick it one last time for you to wrap up the segment. We can talk, what does it look like if a typical client comes in, reaches out to Gulf Coast Financial Advisors, reaches out to me, reaches out to Pedro, decides, hey, we want to talk about our financial plan, including the risk management things you guys were talking about on the radio. I reach out to Jay, we have that meeting. What's that process look like with going through application? And what is, in general, just what's the underwriting process look like in modern times, 2024 going into 2025?
Well, assuming we've consultated and we understand that the client is interested in some sort of risk mitigation, whether it be long-term care, life insurance, or disability income protection planning, we've gotten the go-ahead to start an application process. We do, obviously, we shop the marketplace. We give some preliminary premium figures for them to consider, make sure that fits within their budgets and their guidelines. We make sure that the company that they're going into is a good company, has good policyholder service, and has efficient and effective underwriting. Once they've decided, in this day and age, a lot of it's done electronically. So if Pedro comes and says, hey, I'm ready to do that $500,000 20-year term, I don't even have to visit with Pedro in person. We can talk on the phone or a Zoom call. I can get the necessary data. I can enter everything in, and through the magic of email and secure online platforms, we get great, efficient applications in a matter of minutes. That then goes into an electronic process for the different companies. Those companies, they order, you've given them permission to order prescription history, motor vehicle reports, medical information bureau data, which is doctor data, if you will, and you've given them the green light to either evaluate that data or ask for a blood and urine sample. A nurse comes to your office. Some companies allow for you to get coverage up to $5 million without doing that. If you're in really good health and don't have any prescription medication, you can fly right through underwriting. But some people say, hey, I've got a little chink in my armor. I take a little blood pressure check or a little cholesterol here, whatever the case may be. We set that exam up at no cost. They then go through the underwriting approval process. Policy is issued, and then we get to send that policy to them electronically or deliver it in person.
Very good. Listeners, if you would like to continue this conversation about either your individual retirement planning needs and risk management needs, or more importantly, I want to make sure I stress this, Jay, for you business owners, remember, not only through Jay's company, Providence Benefits and Providence Partners, not only can we handle the risk management and insurance needs of individuals, through our affiliation or our joint work with Gulf Coast Financial Advisors, we can also handle your employee benefits, including all. Go ahead, Jay.
That's it. Group benefits, core. Think life insurance. Think short-term disability, long-term disability, critical illness, accident coverage, dental, vision. That is a core benefit package. We can go down to 10 lives.
Right. And on the investment management side, good for you, Pedro, we can also handle 401k planning, simple IRAs, SEP IRAs, all the thing. Got it? Okay. So listeners, if you're interested in continuing that conversation, give us a call, 251-327-2124, or you can reach us through our website, gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Now on our site, you can choose to send us a direct message, or you can click on the blue button in the upper right-hand corner. That will put a 15-minute introductory phone call on my calendar. Or you can do all the above. Just reach out to us. We encourage it. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles related to our topic of the day. Special articles that pertain to those of you in or near retirement. So join us after the break to hear Jay and I discuss this week's relevant headlines with our news headline of the week. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's G-U-L-F, like the Gulf of Mexico, Coast, F-A as in financialadvisor.com. Welcome back to Coasting Retirement. Host Josh Knoll here. So as we discussed before the break, every week we scour the internet for financial articles related to our topic of the day. Special articles that pertain to those of you in or near retirement. Our job, or at least we think it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, a quick note, if you want to read or referenced articles yourself, we include the links in our show transcript, which you can find on our website, gulfcoastfa.com, under the podcast tab. We upload those episodes every Monday after the show airs on FM Talk 106.5 every Sunday. Now, with Michelle playing hooky and still recovering from Costa Rica, I'll be the one reading the headlines this week, Jay, so let's get after it with our news headlines of the week. All right, you ready?
I'm ready.
First up, and this is one we debated, should we do it or not? But as I told you, I think people want to know, are insurance companies profitable or not? It is from U.S. News and World Report. It's a pretty much fresh off the press article here, Jay. It says, quote, how do life insurance companies make money, end quote. And the reason that we debated about going back and forth, because my opinion is this, Jay, and I think this is very consistent with long-term listeners of this show. I do believe that in general, consumers, clients, prospects, all that can get a little turned off by quote-unquote high commissions being paid to insurance agents, right? Now, sometimes there's context to that, but I think in general that's a broad statement. However, I do think that most people are concerned with the profitability and the claims paying ability of insurance carriers, especially anyway that down here on the Gulf Coast has dealt with P&C carriers and a hurricane.
Absolutely.
Right? Do they have the same, do life insurance carriers, do they have the same makeup on how they make money? And in general, are there events like a hurricane, like a Category 5 hurricane that can happen to a life insurance or disability or long-term care insurance carrier that may impact their ability to pay claims?
Pay claims.
Lord
Let's
almighty,
get it out.
man.
No, so I don't think
I'm still on Costa Rica time.
Pedro, I don't think a hurricane or a Brazilian flood is going to impact the death and mortality rates unless it's something that's prolonged and lasts for a very long time and kills hundreds of thousands of people.
Let me rephrase that.
Agreed.
However, life insurance companies, when the actuaries calculate their premiums, those premiums are collected, and that's the profitability of the insurance company. Now, clearly, an insurance company that takes or issues a policy on a 25-year-old male, and he's paying the probably the least expensive rate possible out there for a $100,000 10-year term. If he dies 2 months later from natural causes or an accident, the insurance company didn't do too well on that one.
No, that's one they're going to eat it on.
Yeah, but
significantly.
they're playing the odds,
right?
So there's a statistics out there that says about over 90%, I don't know the exact one, over 90% of term life insurance policies do not pay a death benefit.
Right.
They are simply there because people live past the term that they bought, 10, 15, 20, or 30. Now, some of those early ones we talked about, 35 or 40, those might pay out, and so you'll see higher premiums for those. But the life insurance companies price in, obviously, those premiums from those CSO mortality calculation tables. They build in profitability. And yeah, we do want our insurance companies, and most of them have been around a very, very long time. They are very profitable, not too much, but they do really, really well, and you want them to be very solvent and they have standards that they have to meet. They have reserves that they have to keep, and that is managed by a lot of the life insurance, the councils, They require certain companies to have a lot more than what they actually have on the books in death benefit. They require them to have a lot more money socked away so they can pay claims down the road.
Okay, I got a couple things related to this, Jay. First, in the rare case, I've been doing this 16 plus years. You're how many now? 25 plus?
26.
Okay. So when somebody says what happens when the insurance company, if the insurance company goes out of business, first I tell them in the life insurance, disability, and long-term care world, I can't off the top of my head name one that has. But if they do, in general, what happens there?
Well, typically people will ask that question, and over the last 50 years, there have been a couple of companies who hadn't done so well. They made wrong or they had bad management decisions. Most recently, there's a couple of companies in the news that just had to make some changes. They'd stopped offering product. More often than not, the company's book of business is purchased by another life insurance company.
Right.
There's a lot of companies out there who have just kind of changed the way they do things. They've chosen not to be focused on life insurance and they want to be only on group, or they've chosen not to be in group and only on life. Some offer only annuity contracts. So there are lots of different insurance companies out there, but if one is not doing too well financially, typically they get bought up or absorbed by another insurance company, and that policy still remains intact. But instead of doing business with ABC Insurance Company and calling their claims and policyholder service, now we're calling XYZ Company.
Very good. All right. Last thing as we wrap up this article, Jay, and it transitions us to our next one. Again, I've been doing this over 16 years. You've been doing it over 25. I don't recall ever seeing a premium increase on existing policyholders for life insurance. I could be wrong, but I don't ever see it, nor have I ever seen it on disability. What I have seen is premium increases on long-term care.
Yeah.
Why is that, and what can people do to protect against future premium increases on long-term care?
So yes, also in my career, I've never seen a rate increase on life. I've never seen a rate increase on disability. However, on life insurance, they do disclose those, fully disclose what the rates could go to inside of a contract with whole life or universal life. Those are always fully disclosed. We don't see them in disability either, but in long-term care, we see claims experiences of companies. They didn't price it right the first time out. And so we had a lot of companies write traditional long-term care many years ago.
When you say Genworth would be the
Genworth is probably the largest, another couple of companies that come to mind, but Genworth's still in the news. Still, they still offer long-term care services.
Right, that's
have a policy block of business. They just offer. They don't offer any new.
Right.
John Hancock's another insurance company that offered long-term care that doesn't offer new long-term care anymore. But they occasionally a policyholder, depends on the year and the claims and the experience of the insurance company at that time and that year, they might get a letter of a rate increase.
Very good. All right. So let's transition to Jay, how can someone make sure that their long-term care premium does not increase before I transition to the next article?
Well, they buy a hybrid type of product that has a guaranteed long-term care premium.
Very good. Last article for this week, Jay, because we're running a little long. It is from Kiplinger, one that we reference a lot. It's a great site, kind of cuts down the middle on a lot of topics. The title of the article is 4 Secrets to Buying Long-Term Care Insurance. I picked it because, again, life insurance and disability income are definitely on people's minds. And having, again, done this for a long time, I can tell you that the ratio of people using their disability income policy is pretty high. It's actually kind of surprising. Back when I was more in that world, I was constantly handling disability income claims, okay? But to be fair, the topic du jour on people's mind when it comes to risk management, I think, is long-term care. So in this article, Jay, on Kiplinger, again, 4 Secrets to Buying Long-Term Care Insurance, one of the things that they talk about, and you just mentioned, is, or you talked about earlier in the segment, was assessing your risk. Are you of the age? Do you have the risk? Is there family history? What have you dealt with personally? And as you said, Jay, a lot of people are dealing with this. In fact, a majority of people are dealing with some type of long-term care thing, which leads you into the next question in this article, which I'm going to turn it over to you. It says, once you've assessed your type of risk and how important this is to you, then you have to ask yourself, how much of that risk do I want to transfer to an insurance company, and how much can I tolerate on my own? What a lot of people call self-insure, what Jay refers to as self-pay. So I'm going to turn it over to you. The 4 things around long-term care, the timing of buying it, the risk assessment, the sharing of the cost, if there is any. How do all those factors play in when you're having the conversation?
The younger and healthier we are, specifically, we even talk to people in their mid-40s to late 40s now about long-term care. 10 years ago, it was people in their approaching retirement age, 60 and 65. We can go as far out as age 85 for some long-term care annuity-type products. But anywhere from 45 to 85, the younger you are and the healthier you are, the likelihood of you getting a policy and getting approved, and the premium, if it's traditional, it's going to be less. If it's a hybrid, the money we put into that contract, we're going to get more leverage the younger and healthier we are. Then you have to decide, again, how long do I want my policy to last? Am I comfortable with only a 2-year benefit period? Do I need something that's going to go the average of a nursing home stay, which is 4 years? Do I want something that's going to project out longer, which is 6 or 8 years? There are policies you can design to get that. There is even a lifetime guarantee, continuation of benefits policy rider that you can add on one specific hybrid contract. If anybody's interested in that, certainly reach out to Josh or me on that. And then, of course, your health. What ailments, if any, have you experienced? Even in their mid-40s, somebody may have had a cardiac event.
Their knee fell off their leg, like me.
Too much basketball, getting knocked out by Pedro under the basket. There are plenty of people that have ailments that are considered morbidity. Mortality is life insurance. We talked about that earlier. Morbidity rates of disability and long-term care is what insurance companies use to price that. So they want to evaluate an individual's morbidity rate, the likelihood of them needing assisted living care. Some of that could revolve around maybe a broken hip or osteoporosis. Some of it might revolve around the cognitive issues, Parkinson's or Alzheimer's. So we have a whole series of knockouts, if you will, or things that we need to consider for clients when they're looking at long-term care. So the younger and healthier you are, the better. But it doesn't mean if you're in your 80s, you can't still get a plan. You can.
That's amazing.
Yeah. Then how long you want it, and then the amount of benefit you want to consider.
Very good. Well, listeners, if you're interested in continuing that conversation, and I think we all agree that these things we're talking about with long-term care and the various risk management, these are important pieces of information for you to know, and it impacts definitely those of you in or near retirement, then give us a call. We can continue the conversation, 251-327-2124, or again, go to our website, gulfcoastfa.com. In the upper right-hand corner, there's a blue button that will put a 15-minute introductory phone call on my calendar. It is, everything we do is no obligation, no fee. All right, Jay and Pedro, we are running so short on time that we're going to dive right into what is normally our segment 3, which is called Joshua's Crystal Ball and Big Mouth. So we got to be a quick hit on this. Here's what I'm going to tell you. So new listeners, every week we do a segment where I talk about some of the predictions I've done publicly. I talk about some of the things that I thought were going to happen that I staked with. And a lot of times, to be fair, and not to pat myself on the back, but I'm fairly skeptical about financial services and some of the broader things that our industry does. So a lot of times I'm actually proved right. But there are definitely times that I swing and miss, and those are the times that regular co-host Michelle likes to eviscerate me, but she'll get me back next time. But so what I want to do, Jay, was just jump right in it. I'm going to be totally open and honest here. This is not a political show. We don't do political predictions.
Never have.
In fact, last time when I asked you, you said the only thing I can predict about the presidential election is that half of America is going to be upset, right? But I want to lay out something that we've talked about often here, and I want to own the fact that I was wrong and get your very quick thoughts. Are, one, I thought the election was going to be close, right? And two, I thought that crypto and Bitcoin at this point of the year, I thought that it would already be going the way of, I called it the Bitcoin beanie baby. But to be fair, I have been radically wrong. I still hold that it is called the greater fool of investing. When these things have no inherent intrinsic value, the only way that they increase in value to sell is if you find somebody that's willing to pay more than you paid. That's called greater fool investing. And I use the Beanie Baby because when I go back to my childhood home, my mom's got a big old trunk full of Beanie Babies that they spent God knows how much money on that are worth nothing now. So, all right.
That's interesting.
That is interesting, right? So I swung and missed on the election, and I definitely swung and missed on crypto and as particularly.
You swung and missed on the election because you thought it was going to be close.
I thought it was going to be close.
It was a clean sweep.
I thought right. I thought it was going to be razor.
Whether you like it or not, it was a clean sweep.
It left no doubt.
Then up until these next midterms in a couple of years after the new president's installed, things are going to happen pretty quickly.
Right.
And whether you like that or not, that's okay. We're not going to get political. However. There are certain components that a lot of people did not see coming.
Pedro, what did you? Are you a crypto guy?
I am a crypto guy, and
Okay.
Bitcoin just hit an all-time high today, didn't it?
And it just proved how wrong I was. Now, am I wrong in the short term or the long term? Listeners, stay tuned on episodes as we move forward. We don't spend a lot of time on cryptocurrency because that's kind of a landmine in our particular part of the industry. But the fact of the matter is, by all appearances, it's here to stay, at least for a while. We'll see over the long term if I'm right. If it ends up being like disco or
Beanie Babies,
or Beanie Babies,
Cabbage Patch Dolls.
or yeah, if it ends up being like that, we'll see. But for right now, I'm wrong, and I'm
I don't
willing
know.
to
A
admit
lot of baseball card collectors still making a lot of money. Comic book collectors too.
I got a trunk full of those too, Jay, so maybe we need to talk. All right, well, folks, I hope you enjoyed the show today. That's it for us this week in Coaster in Retirement. I want to give a huge thank you to stand-in co-host. That's Mr. Jay Stubbs. He's also a part of our show sponsor, Providence Partners. Thank you, buddy, for being here. Thank you to recent coming on producer Pedro Cardozo. He's going to be, folks will be looking for him at the Orange Beach office. He's going to be working all parts there of South Baldwin. And of course, he's available all across the Gulf Coast. You excited, Pedro?
Oh, I'm thrilled. And then let me just share, going back to basketball a little bit, something that made me very excited to join you was in a basketball court, you always leave somebody in a better position than when they started. And that was one of the first things that you said to me is anybody that does business with Gulf Coast Financial Advisors, they are always left in a better position when they started. So I know I adopted that really quickly. And then along with that is assembling a great team and then just sitting here with Mr. Jay Stubbs, incredibly talented, Michelle, elegant and incredible, a warrior, and then the geniuses over at Aptus. So this is super thrilling for me. So thank you, Josh. Thank you, Jay, for letting me sit in and participate with you guys.
Absolutely,
You
Pedro.
don't get any better than that, buddy.
He's got a good radio voice.
Man,
too.
he does. Well, he's going to be doing co-hosting too. And I was a point guard. And back in the day, Jay, I would tell him, back when I could play, I'm no good anymore, but I'd say, you just get open, I'll put the ball in your hands. So I'm excited for this, buddy. It's going to be a great partnership, and we're going to get rocking and rolling. All right, other thank yous. Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Thank you to the provider of the show music. That is local band Sloth Racer. Thank you to show producer. That's my son, Peyton Knoll. He's a freshman at Auburn University. And as always, our sincere appreciation for all of you out there that have been joining us on this journey and listening to our show. We'd love to be a part of your journey as well. Till we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.